Welcome all. Welcome all to the Capital panel here today. My name is Edgar Fahler. I'm a senior industry analyst with the Center for Automotive Research, and I'm very excited to have a diverse group to talk today about the capital markets, because we've covered a lot of very important topics already at MBS, at the conference, around all sorts of technology and things that are disrupting this industry in many, many ways. We also heard yesterday some of the cost that this industry will consume a tremendous amount of capital in order to make these things happen. One estimate presented yesterday is that the industry will spend $300 to $330 billion this year alone on its march towards electrification. So a very timely panel. Again, disruption happening everywhere, but even happening in the capital markets and the way that these things are financed. So I'll keep my opening remarks very, very brief here. I'd really, other than to just give a very brief introduction as to why I think these panelists are very, very important here. Because again, as I said, they provide very, very different viewpoints. We have Trevor Upton here on stage with me. I'm very pleasured to welcome with Mosaic, a unit of a key bank. In his area of focus, and I've asked Trevor to get into it much more detailed about, give you a 3 to 5 minute kind of thumbnail sketch of his firm and how they approach it. But he's really focused on the leading edge technologies and the technologies that disrupt this industry. I have, after Trevor, I'm very pleased to have John Murphy with us from Bank of America. Welcome, John. One of the leading Wall Street analysts, doing some very, very important work that for investors. Some of his reports you may know, Car Wars, Who Makes the Car of the Future, some very, very important work, and follows the stock market day to day. I'm sure his performance is measured on a daily basis with stock prices. So as Trevor looking at more of the advanced long-term view. And then we also have Justin Moreau. Thank you, Justin, for joining us as well. Very, very pleasure to have you. Worked for you personally in the past, a leading investment banker on Wall Street, been with, I've known you with Jefferies and Moelis, and I know you have your own firm and doing, leading the way with the SPAC with the QuantumScape, for example. But I want to really, I'm not going to do your introduction justice. I never do. I try very hard, but you've been very, very active and very, very supportive of CAR. And I'd love to give you an opportunity to tell the folks more. So with that, I would really, and then again, focus really on the Q&A part and try to, because there's so much happening here. Trevor, I'll turn it over to you and give you an opportunity to tell us more about your firm and how you approach things and in your outlook and things for some of these advanced technologies.
Thanks so much, Edgar, and thanks so much for having me. I'm Trevor Upton with the Mosaic Group at KeyBank Capital Markets. I had mobility and transportation, and I co-head semiconductors, which overlaps with ADAS and autonomy. Our goal is to help institutional investors understand how emerging technologies are going to disrupt markets. We do this by building relationships with the founders, technologists, academics, research institutions that are actually driving the disruption. Then we facilitate conversations to help the institutional investors dig deep into what's coming. Maybe one way to help put my comments into perspective is the topics we're talking about are the same: electrification, autonomy, ADAS, connected car data, but the timeframes we look at are longer out. So my prior role as a publishing analyst at KeyBank, and we value companies looking out 1 to 2 years. Before that, I was at Janus Capital, where we valued companies more in a 3 to 5 year time frame. And in Mosaic, our clients are those same institutional investors that are looking out 3 to 5 years, and we help them at the longer end of that. Very much unlike the other two panelists, we also, in Mosaic, are not at all focused on valuation, and so that lets us step back and just focus on the technology in the longer term, kind of 5, 10 year time horizon. So similar topics. Electrification, kind of it's less what's coming the next couple of years. It's how do we go from 2% of sales to 30, 40+%? What technologies are going to drive that? Who has that technology? Who doesn't have that technology? Who has technology that won't be needed anymore? And what happens with that? With autonomy, it's less heads down what's happening kind of this year, and it's more, what sensors will be needed to everything. Can you build on a foundation of deep learning? In ADAS, can you go from level 2 to level 4? And if not, what are the implications for the vendors of those systems? And what are the implications for OEMs? How do you go from level 2 to level 4 if you don't get to go through level 3? And if you do get to go through level 3, what does that look like? So very excited to go deeper into all this, and just very excited to be here.
Look forward to your contribution here on the panel as well. Thanks, Trevor. John, can you spend a few moments? You've got quite a team that you have globally, what you're doing with Bank of America, and how you look at the markets, and if you have any thoughts on outlook as well for the markets, would be very helpful as well.
Great. Well, thanks so much for having me. It's real pleasure to be here. I wish we could do this in person, hopefully next year. But I've been doing this for 22, 23 years now, bumping up on a quarter decade. And it's one of the more interesting times in the industry. And if you were to think about what's going on right now, we kind of frame things as a cyclical versus secular tug of war. And investors are really struggling at the moment, and we're trying to help them out with understanding how you're going to be seeing the future from a cyclical versus secular standpoint. So right now, if you look at the next slide, I'm just trying to pop these up here. Sorry, I don't seem to have control. Hold on a second. Let's just see here. Well, the first slide, when it pops up, this is a long-term graph of the cycle, and where we think we are, right now is bumping off, the trough that we set last year.
There we go.
And here we go.
Yep.
There we go.
Thank you.
There we go. And what you can see, historically is there's been shocks to the system that have driven, troughs. And what we thought was, as the industry was grinding down from the peak in 2016 into 2019, and unfortunately we heard the COVID shock in early 2020. We thought that was the go signal for a trough in the cycle, and it actually was. And I think what we've all seen is this very rapid bounce back up in demand, and that was a very significant question of have we reached peak very quickly in the space of 12 to 18 months, which would traditionally be sort of a 3 to 7 year time frame. But lo and behold, I think we're all very well aware that we have this inventory shock going on in the world around semis. It's driving down production rates, even as that demand is recovering very significantly for many reasons, which I'll get into in a second. And we have this bizarre environment where inventory on an absolute basis, if you look at the graph on the top, is near all-time lows at about 1.5 million units, or modern day lows. And the day supply is incredibly low, and dealers are struggling with getting inventory. So what's happened was, investors were concerned that we pop back up and reaching a peak in the cycle very quickly in 12 to 18 months from the trough in early of 2020 around the COVID shock. But the reality is the industry is now in a moment in time where it's being constrained on this recovery on the supply side because of the supply shock. And we're probably going to see a sales rate, which our official forecast is 15.6, somewhere in the high 15s this year. And the constraint seems like it's going to last and persist into next year. So the shape of the recovery may be governed by this supply shock in a way that creates a more typical cyclical recovery in the industry, meaning we do get sort of a multi-year recovery as opposed to just this 12 to 18 month snapback. At the same time, pricing has been very good for the industry because there's a shortage of new vehicles, to some degree, used vehicles flowing into the secondary market. So it's shaping up to be a very healthy market, but people constantly are concerned that you're reaching a peak in demand or a peak in earnings or both. And that's really a struggle. And when you think about also what's going on the demand side, is you bizarrely have very strong pricing, but your real monthly auto cost of ownership is actually very low. And the graph on the top here is showing a 12-month moving average and a 12-month moving average ex gas. If you were to look at the latest data point, it's significantly below $550. So, versus the past few years, it's very inexpensive to buy a vehicle. A lot of that has to do with used vehicle prices being very strong, so your trade-in value is high, or the resid that's assumed on your lease payment is very high. Money factor being rates is very low. So it's actually, if you can get a vehicle and you're trading in a vehicle or you're leasing a vehicle, it's actually a pretty good time to buy a vehicle if you can get the one you want, right? Which is the challenge at the moment. And in addition to that, what you have also is, as the RMAC, or we call it the RMAC, real monthly auto cost of ownership, is continuing to trend down. You have DPI per capita, or DPI in total, going up, right? So this is a bizarre thing, right? That you have affordability improving dramatically if you own a vehicle. If you're new to the market, you're kind of out of luck. But if you have a vehicle to trade in, or you're going to lease a vehicle, your affordability is very good. At the same time as DPI per capita, or DPI in total, is going up dramatically. A lot of that is stimulus. Some of it is the economic recovery. So we're in this really weird time on the cycle where people are struggling to understand, where this is going to ultimately land. And you throw in a myriad of, a cloud of disastrous risks, some opportunities here. And the biggest one is, smack dab in the middle that we're all dealing with at the moment is COVID and post-COVID developments. And if you certainly understand what's going on, I think we all do, that the semi shortages, secondary of COVID impact. So there's this constant, concern about what's going to occur there in the short run. But then you also have, the future of the industry that Trevor talked about, and we'll get into in Q&A. I'm sure Justin will talk to it as well. Which is, is bubbling up in many, many different ways, creating, risk and opportunity across the value chain, electrification of vehicle. The news out this morning that they're going to try to push for 50% penetration by 2030. I mean, that's our pie in the sky, blue sky. If they throw, probably almost $1 trillion at this in stimulus, the U.S. government to get there. But you're seeing this around the world, and there's this significant push. And people talk about, a once in generation shift in the industry. This is a once in 100+ year shift in the industry. And then there's a very significant question of, do hydrogen fuel cells usurp electric vehicles in the next 10 to 20 years? So there's a lot of opportunity and risk there. In the capital markets, and Justin will certainly get into this, is, we've called auto tech the new biotech. And there's all these companies bubbling up via SPACs, IPOs, in the private market, that are being chased by investors, because they may be the new thing in the auto industry and really drive significant change. And they are getting funded at very low costs of capital, with a lot of capital being offered to them to develop their businesses. So we're seeing that, and that's a really interesting thing. It's a lot of fun as an analyst because we get to look at a lot of new companies, but it's also very important for us to pay attention to that and understanding the risks to the incumbents, and maybe even the opportunities for the incumbents as well. Plus, many other things as far as rates, inflation, deflation, right? You can pick your poison here. There's a lot going on in the industry, and I would say, there's certainly, some been times in the last 20+ years where I've been a little bit bored and think things are kind of mundane, and but that's not certainly now. Just real quick, lastly, when we think about the core to future transition, this is really important, and the industry needs to, at all points in the value chain, carve off the parts of the company that are not really that successful. We've seen that in cars in North America, and focus on the sustainable core, which is trucks and luxury right now, to fund the future. And this is something that the existing companies are struggling with and have to fight, at the same time as you have these new companies entering that are being well funded at very low cost of capital that can focus purely on the future. So it's a real challenge for the incumbents. It's a real opportunity for them as well if they manage this well, but it's a real big opportunity for these new companies coming in. It's really an exciting time to be an analyst in the industry. With that, I'll wrap up. I'm out of time, and I'll turn it back to you, Edgar.
Yeah, I appreciate that, John. And we'll get into a lot of those things. I'm appreciative that you help us set the stage for some of these challenges and some of the transition that's happening and the role that capital will play here. Justin, I'd love to get more about your firm, and you've been right in the middle of some of this disruption and the financial markets, SPACs. We get a lot of questions at a car about what are they, what aren't they, and that. So I'd love to hear if you could provide a bit more background as well.
You bet, Edgar, and thanks for inviting me up to Traverse City. I wish I was there in person. Yeah. I have been attending for probably the last 20 years. It was more of an excuse to go fly fishing with Dave Cole, but hopefully I'll be back next year with John Murphy and the rest of the team here. Yeah. Sure, let me give a little bit of an overview here of what Kensington is today. I know you introduced me as being an investment banker. I did begin my career at Car and Driver magazine in Ann Arbor, and I did work in the auto industry for a few years at GM and Toyota. And then I did spend 20 years as an investment banker. I like to say that I've spent the last 6 years actually coming back from the dark side and really providing some value back to an industry that's near and dear to me, which is obviously the automotive industry. And so I want to just give a little overview of what Kensington Capital is. And a special thanks to John Murphy for setting the stage here, because he's spot on in terms of where these once in a lifetime megatrends are going. And the number one megatrend that we see in the automotive industry is clearly the electrification of the powertrain. And while there may be some alternatives to that in the future, maybe 20, 30, 40 years out, what we've definitely seen is today every single automobile manufacturer in the world and every tier one supplier is focusing all their R&D, all their CapEx efforts into that electrification of the powertrain. What does that really mean from an investor standpoint? What does it mean really for a value chain standpoint? So to set the stage here a little bit, you asked the question, Edgar. I know a lot of the audience is asking the question, what is a SPAC?
Right.
And frankly, a year ago, I don't think anyone even knew how to spell the word SPAC. But to give you a quick primer of what it is, a special purpose acquisition company is an entity that is formed to raise capital. In this case, it's public capital. So you do an IPO or initial public offering to raise a pool of capital, and that capital is used to acquire a business. It's essentially a merger, but it's an acquisition of a business to create a new publicly traded company of that business that's being acquired. Another way of looking at it is it's not too dissimilar from private equity that is taking private capital, investing it in companies. In this case, it's just public equity. In other words, we allow public investors, Main Street investors, to invest with us, allow us to take that capital, our expertise, finding the right company out there that needs this capital for long-term growth. That's a very key point. You're not investing in a slow growth or a negative growth company. This is a company that will benefit from long-term growth. So inherently, it's a company that, as we just talked about, is in one of these emerging growth segments. Electrification is very key. And to skip to the bottom of this page, the expertise of the SPAC is dependent on one thing and one thing only. It's the team that's running the SPAC. It's the management team and the board. And of course, I had to quote my favorite coach down at the bottom, my boy, Bo Schembechler. So if we skip to what does that actually translate into? Well, this is our team here at Kensington. And I'm not going to go through each person on this page, but I'm sure your audience can recognize a few names here. But safe to say, this is a group with over 300 years collectively here of expertise in the automotive industry, not just investing, but running, purchasing, supply chain, you name it. And it's this team that I've been working with for over a year and a half here to really expand the opportunity for investors in the automotive auto tech space. We raised our first SPAC last year, which is the ticker KCAC, and we acquired a company called QuantumScape. I'm not going to go into the details there, but QuantumScape is the leader in lithium metal solid state batteries for future electric vehicles, backing from some of the most important investors out there, including Volkswagen. And so that is a publicly traded company today. The second SPAC that we raised, which has the same ticker, KCAC, we recently announced 2 months ago that we are merging with a company called Wallbox. This is a Barcelona-based leader in EV charging, but it is also at the intersection of not only charging electric vehicles, but energy management. With bi-directional charging, it allows you to park your car and you can not only charge it off of your home grid, your solar panels, but you can take that car and put that power back into your house, your business, or back into the grid. Very powerful statement. We're in the middle of that de-SPACing transaction now, which we hope to close by the end of the third quarter. And as John Murphy mentioned, there's a lot of trends, and as you can see, these trends reflect exactly what John was talking about, where we're basically seeing the electric vehicle penetration, we're seeing emerging technology in terms of the overall total addressable market. We all know that cars are becoming more advanced, they have more computing power, they have more semiconductor chips, things like that. These are all trends that we see as being very sustainable, very long-term, and need public funding for.
Yep, need capital. Yeah, thank you. Yeah, thank you, Justin. I appreciate that. You brought up the point that this transition to electrified future is, in your view, if not a very significant trend. I want to put that to the panelists. I'll start with Trevor, because you were looking at more of the advanced. Would you agree with that? Is the most important trend for you and for your clients? How do you view this, the electrification trend and what it's doing to the automotive industry?
Yeah, it's a great question. Electrification is definitely one of, if not the most important change going on in the industry that our investors obviously care about. The most interesting, again, going back to kind of the time horizons we look at, the most interesting implication to me is just electric vehicles are less complex. They're easier to build because you don't have the complicated engines, transmission geometry. You don't have to worry about intakes, exhaust. The skateboards seem potentially more shareable than ICE platforms. And so we combine that with just the importance of scale that has always been important in the auto industry and seems unlikely to be less important, possibly more important with EVs. And I heard it described once that the EVs look more like a big laptop than they do look like an ICE vehicle, and there are electronic manufacturers out there that are very good at building laptops. And so looking out towards electrification, as we look at kind of going from that 2% to 30%, 50%, where are we going to build those? Who has the scale to do it? And I think the most potentially disruptive opportunities are coming in China. And just from EMSs, Foxconn wanting to get into it, some others, Xiaomi talking about billions of dollars putting into it, that EVs could be different enough that you could change the whole manufacturing model. And I mentioned that I look at semiconductors, and there's an interesting model there where some are vertically integrated, where they design and build their own, like Intel, and you have others that design but have someone else build them, like NVIDIA having TSMC build them. And it seems possible as we transition from ICE to EVs that the whole manufacturing landscape could change. I mentioned that I look across different industries and also chat with people doing the automating of the manufacturing process with OEMs, new OEMs, traditional OEMs, and just so many fewer people involved, such a simpler process that it's a tremendous transition, obviously, that the industry is going through. So yes, electrification is definitely big.
Yeah, no, it's curious to get your take from the technology perspective and through the lens that you look at it, because that would obviously create a lot in a more skateboard type orientation type format, would be tremendously disruptive, could be for the industry. And you mentioned Foxconn and the contract manufacturing would have tremendous implications, John, for the traditional automakers and suppliers. I'm wondering, would you echo the view that, in your opinion, is electrification the biggest trend happening right now, with implications for the for the capital markets? What's your outlook? What is your EV type base assumption for 2030, and how do you view this impacting the traditional suppliers and automakers?
So, I mean, I would certainly, echo the idea that on a practical sense, EVs are the biggest, trend in auto tech, at the moment, and are probably the most impactful for the industry in practical terms. I do think autonomous or level 4 or 5 is probably a lot more game-changing for the industry and for society ultimately over time, because the vehicle will be potentially used very differently, more safely, and we can hopefully travel at faster speeds because you don't have the same kind of risk of a dumb human, operating the vehicle. But I do think as you look at these EV manufacturers coming in, it's very important to listen to folks like Elon Musk, which I don't always agree with, but says that the hardest part of this industry is actually manufacturing. And it's very easy to come up with prototypes and batteries, and that stuff is not easy, right? But the real rubber meets the road when you get to mass manufacturing, and no laptop company, no tech company, no Microsoft, no Apple, no Foxconn can do what these auto companies can do. It can't be lost on people that their manufacturing skills, which are not valued that much by many people outside the industry and certainly the capital markets, are second to none. I mean, I think society would be better served if these guys were making medical devices, because they far outstrip the quality that you have in in medical devices being manufactured. So I would say that the hurdle that these new companies are facing is the actual manufacturing process, and I mean, you just have to go to Fremont to understand how disorganized and out of whack that plant is, and what Elon is doing there, and what he's doing even in his new plants, to kind of see the challenge that somebody who's theoretically one of the smartest people on the planet has in actually manufacturing. So I think there's risk that the capital markets will fund these new companies and create a lot of new capacity, right? The industry already has a bit too much capacity, so that's new capacity coming on is a challenge in the mid and long term. But I think that the true threat of new companies really usurping some of the incumbents is probably a lot lower than people realize. And I do think that as these EV companies become more successful over time, their returns and the industry returns and profit will probably be pretty close to what it is right now. So I think the motivation for an Apple or a Microsoft or a Foxconn to get involved in this industry ultimately should be questioned by their investors, to put it politely. So I mean, it's and our official forecast right now are 7% by 2025, 20% by 2030 in the U.S. Our global teams are looking for more like 30 to 40% out in 2030. Like I said, if the Biden administration and Congress comes in with massive stimulus, basically where you take the $7,500 tax credit up to something at $10,000 to $12,000 and make it unlimited, and then somehow the infrastructure is paid for, which will take a whole other set of stimulus, you're probably looking at least $500 billion stimulus on the auto side to potentially get to this 50% target in 2030. But as far as the value chain being able to handle that, the distribution channel being able to handle that, and ultimately the electrical grid and infrastructure being able to handle that, we're just not there. So I mean, you'd have to pull trillions and trillions of dollars of capital into this to get this done in the U.S. So those targets are targets and not really that practical at the moment, at least in my opinion, from what we can see.
So, no, it's very interesting. There's quite a bit of challenges, both from the startup standpoint in actually manufacturing a vehicle that meets consumers' expectations for quality and all those things, John. But then also on the flip side, obviously these startups don't have some of the legacy businesses that have to be transitioned over either. And in order to, if we were to get anywhere close to these very ambitious kind of government policy and targets. Let me ask, in your opinion, Justin, start with you. What is the investor appetite for still for some of these tech startups and some of these companies that Trevor's evaluating the technology, and there seems to be still quite a bit of interest amongst investors from at least understanding the technology and how these things are disrupting. But what is the investor appetite these days for capital? It's going to require a lot of capital to get these vehicles produced.
Absolutely, Edgar. It's massive appetite. I mean, if we just step back and look at just the North American market alone, there's only about 90 publicly traded automotive companies and suppliers, representing a little under $1 trillion of value, and a bulk of that is Tesla. Whereas you look at the private market for companies, there's over $2 trillion of enterprise value of privately held automotive-related companies. So we still have this real big imbalance. But going back to John's earlier point, the automotive industry, it is the most complicated industry in the world. From a manufacturing standpoint, from a tolerance stacking, from a quality control, from just a pure supply chain, as we're witnessing right now with the semiconductor shortage. And so, when people rush into this market and come out with a, new vehicle, electric vehicle, the flip side of automotive, even though it's a manufacturing-centric industry, is that it's also very exciting. When people see a new product design, they get excited about it. They want to own that vehicle. They don't really care how it's built, and frankly, most of them don't even understand how it's built. And I'm sure everyone that's sitting in the room there in Traverse City, whether you're making an entire car or whether you're making, a hinge for a door for that car, it's a complicated manufacturing process. Very few people appreciate that. Very few people understand the capital required to manufacture these things. So, what we've identified and we think provides a very good investment thesis is those companies that are extending themselves into this electrification strategy or this kind of new megatrend strategy, but they're extending it with a manufacturing footprint or understanding that they've already proven in the past. And that's critically important, because otherwise they're just going to burn through the capital.
Right. They're
going to come back to the capital markets. They're going to have to raise equity and be dilutive to their equity shareholders. And that's unacceptable, really, from our standpoint. And that's why you got to have the right team that's looking at these deals, doing the right due diligence, that has good manufacturing expertise. And you're really backing a management team that has proven their capabilities before and can execute on your capital that you're putting to work.
And that's an excellent point around some of these startups in early technology, is that many of these are backed and do have a strong management team behind them with experience, extensive automotive experience. And so there's no doubt that some of these technologies that you're looking at, Trevor, will have a lasting impact on the automotive industry in one way or another. Necessarily, it either will be if the volumes play out for them. I mean, who really has scale in electric vehicles at the moment besides Tesla? I know everybody's racing to build scale, but there are many of these startups that are starting on with only 2% battery electric vehicles sales in the US on a very similar starting point in some ways. Again, you add the management, but I'm curious, Trevor, from your perspective, what are some of the technologies that you think have some staying power that you're evaluating, these advanced technologies that in one way or another have a role to play here in the auto industry?
That's a great point, a question. And with EVs, a lot of it is less maybe the technologies and more the manufacturing process. I think to Justin's point, we recently hosted an industrial conference with some of the SPACs that we're talking about, and one of the questions that came up was, will they need to raise more capital? And one of them probably will. And so it is an interesting point for some of these companies to be in, to be going public with the likely possibility that they'll need to tap the capital markets again in just a year or so. And I think John could very well be right that the outsourced manufacturing model may not work. It's inherently lower margin. The established vendors do have tremendous experience with it. Where we are seeing it is providing some optionality to some of those startups, whether it's the Fiskars or the Faraday Futures, to possibly lessen the amount of capital they need to get to some kind of scale. And then whether that does go in-house or whether they maintain that model, I think I'm not sure what will happen. But the technology side of getting that scale, I think it's the batteries is one of the biggest challenges. You have some like QuantumScape that are trying to create the future of that battery technology, but at the end of the day, a lot of the autonomous features, the kind of the more leading edge, it's secondary to being able to build an electric vehicle, kind of fundamentally, which I think the other two gentlemen have great perspectives on.
Yeah, I appreciate that. We talked about the transition. John, you on your slide showed this where we have to all these various challenges that the companies are going to have in moving, both with many of them have legacy assets and things with traditional, very reliant on traditional internal combustion engines. How do you see this transitioning happening amongst suppliers? And then Justin, I'd like to come to you after that and say, what role will M&A play in that transition?
I think first, I mean, the industry is going to be very challenged in this in this transition, right? Because as you ramp down ICE assets and ramp up EV assets, whether it be assembly plants or other plants feeding into into the system, you're inherently going to have capacity utilization levels that are less than perfect, and in some cases maybe 50% or less, right? There's going to be step function shifts in that capacity utilization to the upside for EVs, but they'll start low, and to the downside for ICE vehicles. So it's going to be a real challenge. I do think the industry and the incumbents manufacturers' ability to actually assemble might be less parts, but put them all together, manage the supply chain and manufacture an automotive grade is a real advantage. But the technology that Justin is looking at, and going after and uncovering for investors, and what Trevor is looking at for investors, is really important. And I do think you're looking at something when we say auto tech is the new biotech, where the technology will be funded in these smaller companies that are maybe singularly or narrowly focused. They then work their way either into a tier one or into an automaker, and the whole value chain leverages them. So I think in a lot of ways you'll have sort of a similar layering in the supply chain, but the technology shocks will become from these auto tech companies that are like biotech companies. Some of them will flame out, and then some of them will shoot the gap and light the world on fire, and maybe like QuantumScape solve the battery conundrum, or maybe like some of these LiDAR companies solve the issues on sensor suites and ultimately what algos are going. So I think things will be largely set up that way, and there'll be these opportunities for investors to take these long shots, or maybe take shots at the incumbents that'll really succeed down the line. But I think that's kind of how we're looking at how this will be set up over time.
I appreciate that, Justin. What might you add from it? This is going to be a tremendous transition, and from your days as in investment banking.
Sure, I'll put my banking hat back on. And when I think of M&A, Edgar, I really think of kind of three strategies for M&A. The first one, which I think you alluded to, is the consolidation strategy. And I think we're going to continue to see that because there continues to be too many players in various sub-verticals within automotive. You could pick any segment. You could pick, stamping. You could pick, certain assemblies. And, in order to be profitable in automotive, you need the scale, and that scale comes with consolidation. So having fewer competitors, still having competitors, but having fewer of them, and having greater scale, that's where we're going to see the consolidation play in the M&A world. I think that the second area of M&A that adds value is really unlocking shareholder value. And a great example of that is when FCA spun out Ferrari. And you look at that and you can see, well, Ferrari now is worth, multiples of what the remaining pieces were. But it was the only way to actually pull that asset out to value it correctly in the marketplace as a luxury goods company and not just a traditional automotive manufacturer. So there's still a lot of opportunities for that, whether it's suppliers or OEMs. But the third segment, which I think is the most exciting for investors is on the M&A area, is for companies to acquire technologies to allow them to participate in these megatrends. And whether it's someone like Volkswagen, who invested hundreds of millions of dollars in QuantumScape, they did that. This is publicly disclosed. They did that to really give themselves a new battery technology for the future. Not for today. Today they're using lithium ion. But in the future, they want to have lithium metal solid state batteries. The only way they could do that, they couldn't develop it internally. They had to acquire that. So they invested hundreds of millions of dollars. Sorry. And another way of looking at that, and this is probably a different example some of us haven't really thought about, but Wallbox is a great example. Iberdrola invested tens of millions of dollars in Wallbox. Who's Iberdrola? Well, for those of you that don't know, it's one of the largest utility companies in Europe. They own Scottish Power. And if you have spent any time in Europe, you recognize that Europeans are much more advanced when it comes to energy management. They are much more efficient. There's a lot more electric vehicles in Europe than there are in the US. And so Iberdrola recognized the opportunity to harness energy management as it relates to people charging their electric cars. So how are they going to be able to capture that growth? They took dollars and invested in a company like Wallbox. We're going to see more deals like that happening. And I think that's a way for OEMs and companies even outside of the automotive industry to benefit from these megatrends that we're talking about here today.
Interesting. With these investments, John, let me ask you, are investors, in your opinion, giving automakers, traditional automakers and suppliers enough credit for they've made a number of these investments already. Ford with Argo. I mean, you can name virtually all the automakers, major automakers have investments in some of these high-tech startups already. And as Justin said, he expects this to continue. Are investors giving them enough credit right now? Is that fully reflected in their share prices, in your opinion?
So, we would say certainly no, but it is a complicated formula or puzzle when you're looking at the automakers, because there's so many moving pieces, a la what we just heard from GM yesterday around the pressures they're facing from chip shortages, rising raw costs. I mean, there's just so many factors that you're looking at when you're looking at an automaker. So that's it's a complex
Right.
algorithm to figure out what their earnings are going to be. When you're talking about a startup that has a singular focus, and you're betting on or investing in the opportunity for them to succeed and potentially grow massively in size relative to where they are right now, there's a much higher potential reward, obviously much higher risk, but your factor model is usually 1 or 2 as opposed to 100, looking at many different countries. So I mean, there is a there's a balancing of sort of the complexity of what's going on in some of these large automakers versus the simplicity of what's going on in some of these startups. That is really kind of a challenge for investors. Because if you think if you're pitching an investment idea, you're saying, listen, I believe in electrification. I believe solid state's going to be win. I'm going to go with QuantumScape, right? But if you say that's what I believe, which automaker are you going to pick, right? Probably Volkswagen, kind of. But then there's a million other things that could go wrong or right at Volkswagen on top of that. So it's a very challenging thing. So I personally don't think they're giving them the kind of evaluation or recognition that they should get. However, you do have to understand that there is this complexity in those business models that inherently are reasons they have lower multiples. So that's it's a challenge.
Let me ask, and then I'd like to go on to autonomous vehicles, but I'm curious, both John and let me start with you, Justin. Do you expect that there'll be more activity this year and next year to unlock some of that shareholder value, some of these investments around autonomous vehicles, in some of their investments in you mentioned Volkswagen with QuantumScape? Do you expect more of the shareholder value to be unlocked, if it's IPOs, if it's in some of these investments this year? What's your outlook?
Well, like John, I really hope we see autonomy accelerate, because that is a game changer. I would love to just get in a car and close my eyes and show up somewhere. So I think all of us, but I think we all also recognize the reality that that's a very long way off, and there's a lot of legal and political and governmental hurdles we have to get through. Having said that, there's a tremendous amount of backlog of deals that are pending right now. So clearly there is investor interest in that segment. But it kind of goes back to maybe a theme that we have at Kensington, which is, we want to provide the shovels and picks to the miners. I can't tell you which miner is actually going to strike gold. And so, I can't tell you which new electric vehicle company is going to be successful. I love all these new cars coming out. They're beautiful, but I can't tell you whether one of them is going to win or not. And all of us over the years, we've read, all the numbers coming out from, IHS about, which car volumes are supposed to be there, and they don't get it right. So how am I going to guess which car is going to be successful? Same way, I can't tell you which LiDAR company is going to be successful. I don't know which technology is going to be the winning technology, but I can tell you that we're going to have more electric cars. That's a fact. And can I support all the electric cars out there by trying to back companies, suppliers that are going to support the entire electric car universe? Yes, that's a strategy I think is bankable, and I think that's one that's probably better suited for public retail investors to focus on.
And as you said, and you expect the appetite is still there amongst investors for that?
In autonomy, there's a huge backlog, not only of SPAC-related deals, but just of other venture capital-backed deals and deals that are buried within some of the OEMs. They have a lot of autonomy businesses. They may decide to spin them out as standalone companies. They may bring in outside capital. Who knows? But there is definitely a backlog of autonomous investment opportunities.
John, anything real quickly to add?
Yeah, I mean, without getting into specifics, I mean, I wholeheartedly agree with Justin. There's just tons of stuff that's going on. I mean, and just as you think about what this means, right? I mean, and why there's so many things that are going on now and going to be bazillions of things going on for years to come, is the game-changing event on level 4 and 5 autonomy is that you might be able to drive mobility and people's ability to move around faster and farther at lower prices and safer than ever before. And that's what this damn industry does. I mean, there's often this identity crisis of this industry of, low returns, low margins, we pollute the planet, blah, blah, blah. But like, you should, on the flip side, think about the positive is like every day, the large majority of the people in the United States and a lot of people around the planet get in their car and go to work. And if they didn't have that car to go to work, they couldn't go to work. They couldn't take their kids to school. They couldn't get, they couldn't get food. So like the idea that you could then make that happen faster, easier, and cheaper for those people, and potentially a lot of people that don't have access to that, is tremendous. And that's really what this industry does. It brings people together and allows them to live their lives in ways that they couldn't before if they were hopping on a horse or a bike, right? And it's so there's so much that can happen with level 4 and 5 autonomy that there's going to be just tremendous opportunities, for years to come. And hopefully we crack the code, because I think we'll all be a lot better off if it really works.
Can you, Trevor, can we peel back that layer of the onion a bit more about what you're seeing and some of the tech trends that you believe are significant within the autonomous vehicle area?
And completely agree with John and Justin that autonomy is obviously going to be revolutionary. I think the challenge is that so many of these companies are scaling before having a solution. That the approach seems to be, for a lot of these vendors, whether they're chip vendors providing solutions, whether it's startups, whether it's someone like Tesla or established OEMs, that just this idea that you can brute force autonomy, that if you throw enough data at enough compute and throw enough engineers at it, that you'll solve it. And they might, but it's not clear when that will happen. And I can't really think of any example where we've gone from 0% of a solution to 100% of a solution in one go. And in technology, we generally make a bad version of a thing and then make it better over time, but there's no bad version of commercial autonomy. If you haven't fully solved autonomy for whatever your operational design domain is, you just don't have a solution. That's why we have a lot of these autonomous vehicles on the road with safety drivers or with very limited ODDs. And so how are we going to get there? I think, going back to M&A, I thought it was fascinating that Uber sold their autonomous effort last year in December, Lyft sold their autonomous effort this year, and robo-taxis kind of was the autonomous business model. And I think that there's a realization that it's harder or farther out than we think, which has kind of been the trend with autonomy, right? Like mid-20-teens, everyone says we're going to have fleets of robo-taxis on the road by early 2020s. A couple of years later, well, maybe later, maybe it'll be more scaled down. And this gets to another point of, this is more fundamental, but can you build a safety critical feature on a foundation of deep learning where you don't really know what it learned, why it learned it, or how it learned it? How do you validate that? How do you demonstrate that it's safe? And just frankly, what is good enough? There's so many vendors working on autonomous solutions, and I'm not sure any of them have identified what a testable end state is. And so I'm incredibly excited about it. I'm not sure how close we really are.
Are there any signposts? Because it's very interesting. It's a very complex issue, and as you said, there's appetite amongst investors. More things coming. A lot of activity. Are there any signposts from that your institutional clients sort of look for, or how do they? As you said, I mean, eventually it can be solved. And the capital seems to be there. Are there any signposts in the near term as we walk there that you see there folks really care about?
Yeah, it's I don't know if funny is the right word, but there's definitely a positive feedback loop between vendors trying to solve autonomous driving through brute force and vendors like NVIDIA, the vendors like Tesla that are pursuing this. And I'm not sure in the short term and maybe even medium term if it matters if those approaches are right from an investing perspective. As long as the money keeps flowing, they're going to be investing opportunities. And so this is an opportunity where I look out longer periods of time, and it doesn't, I mean, perception is reality, especially in financial markets a lot. And so I don't have a good answer for if they're signposts. I think eventually it will come to a head, and either these deep learning-based approaches to autonomous driving will be safe enough that we just don't care that we don't understand it, that it won't matter, or it won't be good enough, and we'll need to rethink how we're approaching it. And I think that could potentially be an ugly time for a lot of these companies that, again, that have scaled, that have acquired other companies, that have gone public, but don't yet have a solution that can be deployed.
So I would imagine, Justin, that there are implications for the M&A, the consolidation even amongst these technologies as the landscape sorts itself out, and as we get more clarity around which business model is more viable, which technology is more viable. I would imagine, would you expect more consolidation then amongst the AV space as we're continuing to raise capital and as a number of these new ventures are coming to market?
Well, we are clearly going to see a lot more activity. The only question is who's going to be doing the acquiring, because it's very difficult to have a traditional tier one auto supplier that's trading at 6 times EBITDA trying to acquire one of these startup companies that's valued at $1.5–2 billion. Shareholders are going to be a little impatient with that type of transaction. So it's going to be a little difficult to see what happens there, and I think what we're going to have to see is some very big companies, whether it's tier ones or OEMs, step up to the plate and make a very big investment decision, and see how the capital markets react to that. That's not a universe I play in anymore. That's probably a little bit more in John's universe, that he opines on those types of situations. But I think we're going to continue to see the public capital markets, whether it's SPACs or IPOs, will continue to provide that capital for these very high growth, high value companies, because as we've already said, the public investors like this. They want to put their money to work here. They want to invest in the next Tesla type company. They want to park their money and leave it there for the next 5–10 years, and they're willing to spread it out on a few of these technologies, and they're hoping for that 10 to 20 times return. They don't know which one it is, but they're gonna spread their investments out, and that's what we're seeing, and that's why the public markets have kind of come back to automotive in a big way. 1 year has occurred. A year ago, there were no SPAC deals done in automotive, and there were really no IPOs done. And since that time, I think we've seen over 45 transactions. So 45 new publicly traded automotive-related companies. That's an indication that the public market wants to invest in this segment.
If I can share a very quick anecdote.
Yeah, please.
Institutional investors generally know what they invest in very, very well before they invest in it. With SPACs, that's changing. We had an institutional investor client reach out to us trying to learn about an EV company because they had put some cash into a SPAC that bought something they weren't expecting it to buy, and now they needed to learn what they actually owned. And that's a very unique thing for institutional investors, I think, just to highlight Justin's point around the demand in the space.
Trevor, I just want to add a little comment on that. One of the very first deals I ever worked on as a banker back in the early 90s is we took a company public, little company called Bestop, made truck accessories, and we took it public in a $21 million IPO. Okay, those days are long gone. And that institutional investor that you're referring to, Trevor, back 20, 30 years ago, they were able to invest in these small IPOs, and they got to know the company over many years and invested more capital. And as the company grew, they invested more and more capital. The problem is those days are gone. And what's happened is all of these companies have gone to private equity hands until they become $2, $3, $4 billion companies, and then they go public. And what it's doing, it's causing a problem for the institutional investors out there, the big mutual funds, the pension funds, the insurance companies. They can't get invited to the table until the companies are so big. And so they're actually looking at the SPAC market saying, listen, there's no other way we can get into these companies until it's very far along. We're going to invest in SPACs because you know what? The SPACs are bringing more of these deals to us, and we get a taste for the company, get to know the company, know the management, and over time we can put more capital to work. So that's one of the fundamental reasons why I believe SPACs are here to stay, because they are supported by the institutional investors.
I wanted to make sure we get a couple more questions from the audience as well. One of them that came in is around the government role for battery electric vehicles and the incentives. How important is it in order to meet, is it embedded in your assumptions at all, John, in your outlook for your 2025, 2030, your sales outlook, if you could kind of refresh our memories exactly about your outlook, and then what's needed from the government in order to move the needle and to accelerate that?
So for right now, we're using the current scheme of $7,500, limited to 200,000 units for each automaker to get to that 7%, 20% in 2025 and 2030 here in the U.S. to be U.S. centric. If we can get to a point where you see $10,000 plus, and you pull the plug on the limit, and just say, hey, listen, there's no more limit on each manufacturer. You can drive those numbers up to closer to 25% in 2025 and 50%, close to 50% in 2030. Now, those are just the math. Whether the supply chain can handle that, whether the electrical grid can handle that, is highly dubious, and seems like there's going to be some other significant bottlenecks. But sort of our base case is, current stuff, policy as we know it, and then, future, which is being discussed, as we speak, is that there will be, a ramp up in the incentives, and you look at something that's basically $500 billion of money pushed towards the industry for consumer incentives. And then there's a question of how much money is going to have to be put into the supply base and to the automakers and the battery manufacturers to drive this forward. And I would say it's at least equal to what's going to happen on the consumer side, if not greater. So, horseshoes and hand grenades, you're looking, if you really want to do what they're talking about or is being rumored today, $1 trillion, right? Just, to get this done. And they talk about billions of dollars here and billions of dollars there, $70 billion. You got to put a T on this thing and really understand what it's going to take to get there. And I'll tell you, what Justin's working on and what Trevor is looking at for his clients, there's going to be a lot of money to be made, right? Even in the companies that may not succeed, there's a lot of money that's going to have to be pushed in this direction, and there'll be a lot of money made by somebody in the process.
Yeah, I would just add, we don't factor in any government incentives at all in any of our business models. Others, look at it differently, but we look at that as frosting on the cake. But to John's point, just take an example, $7.5 billion earmarked for EV infrastructure. That's basically public and private charging. That's going to be great if that's out there, but we don't factor it in. But it's coming, and it's going to be coming fast, and it's going to benefit the entire value chain. But also, I'd like to just highlight, it's not just in the U.S. Spain, for example, has a $73 billion infrastructure investment fund that they're doling out as well. And every country around the planet is doing the same thing. So this is global, and investors should keep that in mind.
And then really quickly, from our perspective, we look at what change technology is fundamentally driving. And with EVs, to some extent, supply is driven by government and demand is driven by government. And that's not a fundamental technology issue. And so it will impact kind of who wins as those funds are allocated, but it's a very different spot for us to be in, generally looking at the technology.
Well, I'm sorry to wrap this up, and I'd love to have more time, but we're out of time. And thank you all for my guests. Terrific discussion. Appreciate it from very, very different angles. And thank you all for your time and attention.